The IRS published a rule change that directly affects every American 65 and older. It was buried inside a massive piece of legislation. It was never explained in plain language to the people it affects most. And as of right now, the majority of seniors filing their taxes either don't know it exists or are misunderstanding it badly enough to leave real money on the table. Here is the number: $6,000. That is the new additional deduction available to every taxpayer age 65 or older for tax years 2025 through 2028. $6,000 per person, on top of the standard deduction you already get, on top of the extra senior deduction you already get. A married couple where both spouses are 65 or older can claim $12,000 in additional deductions. $12,000. That did not exist before this year. For many retirees, this deduction is large enough to completely eliminate federal taxes on their Social Security benefits. For others, it drops their tax bracket entirely. For nearly everyone it affects, it is the single largest new tax break they've had access to in decades. And the deadline to use it is not permanent. This deduction expires after 2028. You have 4 tax years: 2025, 2026, 2027, and 2028. That's it. After that, unless Congress extends it, it is gone. Every year you file without claiming it is a year of savings you cannot recover. Here's the part that should concern you. According to analysis from the White House Council of Economic Advisors, with this deduction in place, only about 12% of seniors will pay federal taxes on their Social Security benefits. That means 88% of seniors should owe zero federal tax on their Social Security. But that outcome only happens if you file correctly, understand what the deduction does and doesn't cover, and avoid the 3 specific mistakes that are already sending people to file returns that cost them more than they should. I'm Lucien Vale. Today's video is structured specifically around this deduction: what it is, who qualifies, how to calculate whether it eliminates your Social Security taxes entirely, the 3 mistakes that cost people money even when they think they're claiming it correctly, and the broader strategies that work alongside this deduction to keep as much of your retirement income as possible away from the IRS. This is a long video and I'm not going to rush it. The calculation involved here has real nuance, and the mistakes people make are specific enough that understanding the exact mechanics is worth taking the time to get right. Get a notepad. The numbers in this video are worth writing down. Subscribe before we start. Rules like this change every year, sometimes in your favor, sometimes not. This channel translates those changes into what they actually mean for your tax bill before the filing deadline arrives. Let's go. The legislation behind the deduction. The new $6,000 senior deduction comes from the One Big Beautiful Bill Act, a major piece of legislation passed in 2025. The bill covers a wide range of tax provisions, and the senior deduction is one of them. It was not given a memorable name. It was not announced with a press conference specifically directed at retirees, and the IRS guidance on it, while publicly available now, is written in the dense regulatory language that federal agencies use by default. The result is exactly what you'd expect. Millions of eligible seniors either don't know the deduction exists, don't fully understand how it interacts with their Social Security taxes, or have been told incorrectly that the legislation made Social Security tax-free, which is not what it does. Let me be direct about what this deduction is and is not, because the misinformation circulating about it is actively causing people to file wrong. What it is: a new additional deduction of $6,000 per eligible individual, $12,000 for a married couple where both spouses qualify, available for tax years 2025 through 2028. It stacks on top of the regular standard deduction and on top of the existing additional standard deduction that seniors already received before this law passed. It is available to both people who take the standard deduction and people who itemize, and it directly reduces your taxable income, which in turn can reduce or eliminate the portion of your Social Security benefits that the IRS considers taxable. What it is not: it is not a tax credit. It is not a refund. It does not make Social Security benefits universally tax-free. As USA Today and AARP have both explicitly clarified, no provision in the legislation makes Social Security benefits tax-free. If Social Security is your only income and you already owe no federal taxes on it, this deduction may not change your tax bill at all, because you're already at zero. And if you're under 65, even if you're collecting early Social Security benefits at 62, 63, or 64, you do not qualify for this specific deduction. The age requirement is 65 on or before the last day of the tax year. This deduction, therefore, does not help the more than 13.1 million Social Security beneficiaries who are under 65, including early claimers and most disability recipients. I want to be completely clear about that. This video is specifically relevant to people who are 65 or older. Who benefits most? According to Howard Gleckman at the Urban Brookings Tax Policy Center, the biggest beneficiaries of this deduction are seniors making between $80,000 and $130,000 in income. For that group, the deduction amounts to an average tax cut of approximately $1,100. But lower-income seniors also benefit, in many cases seeing their Social Security benefits go from partially taxable to completely untaxed. The deduction phases out for higher incomes. It reduces by $60 for every $1,000 of modified adjusted gross income above $75,000 for single filers, or above $150,000 for married couples filing jointly. It is fully phased out at $175,000 for single filers and $250,000 for joint filers. If your income is above those upper thresholds, the deduction doesn't help you. But for the majority of retirees whose income falls below those levels, this is a genuinely significant and time-limited tax break. The 4-year window. The deduction applies to tax years 2025, 2026, 2027, and 2028. That is 4 filing seasons. The first returns claiming it are being filed right now for tax year 2025. After 2028, the provision expires unless Congress acts to extend it. This is not hypothetical urgency. This is a defined deadline. Every year between now and 2028 matters. To understand exactly what the $6,000 deduction does for your Social Security tax situation, you need to understand how Social Security is taxed in the first place. Most people know that Social Security might be taxed, but have only a vague sense of what that actually means in their specific case. Let me walk through the exact mechanics. The combined income formula. The IRS uses what it calls combined income, also referred to as provisional income (DARS), to determine whether and how much of your Social Security benefits are subject to federal income tax. Combined income is calculated as follows: your adjusted gross income, plus any non-taxable interest you received, plus 50% of your annual Social Security benefits. That total, AGI plus non-taxable interest plus half of your Social Security, is your combined income for this purpose. There are 2 thresholds that determine your tax exposure. If your combined income is below $25,000 as a single filer, or below $32,000 as a married couple filing jointly, none of your Social Security benefits are taxable. 0. If your combined income is between $25,000 and $34,000 as a single filer, or between $32,000 and $44,000 as a married couple, up to 50% of your Social Security benefits may be taxable. If your combined income exceeds $34,000 as a single filer, or $44,000 as a married couple, up to 85% of your Social Security benefits may be taxable. That 85% ceiling is important. It is a maximum, not an automatic. Up to 85% of your Social Security can be counted as taxable income, but it is then taxed at your applicable income tax rate, not at 85%. Many people confuse these 2 things and believe their check is being cut by 85%, which is not what this means. The critical flaw in these thresholds. Here is the single most important structural problem with how Social Security is taxed, and it explains why the new deduction matters so much. The $25,000 and $32,000 combined income thresholds were set in 1984. They have never been adjusted for inflation, not once in over 40 years. By contrast, the standard deduction, the income tax brackets, and most other elements of the tax code are adjusted for inflation annually. The Social Security taxation thresholds are not. This means that every single year, as COLA adjustments increase Social Security benefit amounts and as other income sources grow, more and more retirees cross these thresholds set when a dollar was worth far more than it is today, and find that a larger portion of their Social Security becomes taxable. This is not an accident, and it is not a mystery. It is a structural feature of how these thresholds were written, and it has been quietly increasing the tax burden on retirees for over 4 decades without a single congressional vote to raise the thresholds. The new $6,000 senior deduction does not fix this underlying structural problem, but it does, for 4 years, provide a significant offset that effectively pulls many retirees back below the thresholds by reducing their taxable income enough that their combined income calculation drops below the point where Social Security taxation kicks in. The math in practice. 3 examples. Let me walk through 3 specific examples so you can see exactly how this plays out, because the interaction between the deduction and the combined income formula is where most people get confused. Example 1. Single filer, Social Security only. Robert is 68 years old, single, and receives $22,000 per year in Social Security benefits. He has no other income. His combined income calculation: $0 AGI plus $0 non-taxable interest plus $11,000, 50% of $22,000 Social Security, equals $11,000 combined income. That is well below the $25,000 threshold. Robert's Social Security is not taxable at all. For him, the new $6,000 senior deduction changes nothing. He was already at 0 tax on his Social Security, and a deduction only helps if you have taxable income to deduct from. Example 2. Single filer, mixed income, moderate total. Carol is 68, single. She receives $20,000 per year in Social Security benefits and has $25,000 in pension income. Combined income: $25,000 AGI plus $10,000, 50% of Social Security, equals $35,000. That exceeds the $34,000 upper threshold, so up to 85% of her Social Security could be taxable. Without the new deduction, Carol faces meaningful federal taxes on her benefits. With the new $6,000 senior deduction reducing her taxable income, her tax situation changes materially. The deduction doesn't change the combined income formula, but it reduces what she owes in actual tax on that income. For Carol, claiming the deduction matters. Example 3. Married couple, both over 65, moderate combined income. David and Ellen are both 69, filing jointly. Their combined income from Social Security, a small pension, and IRA distributions totals $50,000. Some portion of their Social Security is taxable. With the new $12,000 combined senior deduction, $6,000 per spouse, their taxable income is reduced by $12,000. Depending on their specific tax bracket, this could represent a real tax savings of $1,200 or more, or it could be enough to push them entirely below the threshold where their Social Security becomes untaxed. The specific outcome depends on their exact income composition, which is exactly why working through the numbers carefully, not just assuming the deduction handles it, matters. The state-level picture: federal taxes are only part of the story. As of 2026, only 9 states tax Social Security benefits at the state level: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and Utah. West Virginia just fully exempted Social Security benefits as of 2026. 2025 was the final year they were partially taxed there. Every other state plus Washington, D.C. does not tax Social Security income at the state level. If you live in one of those 9 states, your state tax rules are separate from the federal rules, and the $6,000 senior deduction may or may not interact with your state tax calculation, depending on how your state defines taxable income. Most of those states have their own income-based exemptions that can further reduce or eliminate state taxation of benefits, even if federal taxes apply. The bottom line on state taxation: if you live in one of the 41 states plus D.C. that don't tax Social Security, State taxes on your benefits are simply not an issue, and you can set that aside. If you live in one of the 9 remaining states, check the specific rules for your state. Many offer meaningful income-based exemptions that significantly reduce or eliminate state-level Social Security taxation, even at moderate income levels. Now let's talk about the specific ways this deduction is going wrong for people who think they're claiming it correctly. Mistake 1. Believing the deduction makes Social Security completely tax-free and not running the actual numbers. This is the most widespread error, and it flows directly from the media coverage of this legislation. When the One Big Beautiful Bill Act passed, a significant number of news headlines said, in various forms, that Social Security is no longer taxed or that Trump's new bill eliminates Social Security taxes. These headlines were inaccurate, and millions of people absorbed them without reading the correction articles that followed. The deduction is real and significant, but it is a deduction. It reduces taxable income, not an elimination of Social Security taxes. Whether it eliminates your specific tax on Social Security benefits depends entirely on your individual combined income calculation. If you internalized the Social Security is tax-free now headline and filed your return on that assumption without running the actual combined income formula, you may have underpaid your taxes, which creates a problem in the form of a bill and potential penalties when the IRS reconciles your return. Or you may have simply trusted the deduction to eliminate taxes that your income level meant were not actually eliminated, and been surprised when they weren't. The protection against this mistake is simple. Run the numbers. Use the combined income formula I walked through above. If your combined income, AGI plus non-taxable interest plus 50% of Social Security care, is below $25,000 single or $32,000 married, your Social Security is untaxed regardless of whether this new deduction exists. If it's above those thresholds, the deduction reduces your taxable income but does not automatically zero out the tax. Calculate both sides before you assume any particular outcome. Mistake 2. Missing the income phase-out. Claiming the full deduction when income exceeds the threshold. The $6,000 deduction is not available in full at all income levels. It phases out starting at $75,000 of modified adjusted gross income for single filers and $150,000 for joint filers. The phase-out is $60 for every $1,000 of MAGI above those thresholds, by $175,000 for single filers and $250,000 for joint filers. The deduction is completely eliminated. The mistake happens when someone at $90,000 of single filer income claims the full $6,000 without calculating the phase-out. Their income is $15,000 above the $75,000 threshold. The reduction is $60 per $1,000 above the threshold, which is $900. Their correct deduction is $5,100, not $6,000. Claiming the full $6,000 overstates their deduction by $900, a discrepancy that can result in a tax bill and, in some cases, an accuracy-related penalty from the IRS. The phase-out calculation is not complicated, but it requires knowing your MAGI, knowing the threshold, and doing the arithmetic before claiming the deduction. If you're using tax software, this calculation should happen automatically if you input your income correctly. If you're filing manually or working with a preparer, confirm explicitly that the phase-out was calculated and applied to your specific income level. Mistake 3. Triggering the phase-out through poorly timed income events. This is the subtlest mistake, and the one with the most opportunity for proactive prevention rather than after-the-fact correction. Several common income events that retirees make throughout the year can push MAGI above the phase-out threshold and reduce or eliminate the deduction. And many of these events can be timed or structured differently to preserve the full deduction. RMDs from traditional IRAs and 401ks count toward MAGI. If you turn 73 and have flexibility, and when you take your first RMD, consider the impact on the senior deduction phase-out. Taking a large IRA distribution in a single year because you needed a lump sum for a major expense can push you above the threshold in a way that spreading the distribution over 2 years would not. Roth conversions increase MAGI in the year of conversion. If you're doing Roth conversions are a valuable long-term strategy. Consider how the size of the conversion interacts with the $75,000 phase-out threshold. A conversion that pushes you $30,000 above the threshold reduces your deduction by $1,800. That doesn't mean don't do the conversion. The long-term Roth benefits can easily outweigh the short-term deduction reduction, but it means being deliberate about the sizing and timing of conversions in years when the senior deduction is in play. Capital gains realizations count toward MAGI. If you sold appreciated securities or real estate and recognized large capital gains, those gains add to your MAGI and can reduce the deduction. Spreading realizations across tax years where possible can keep any single year's MAGI below the threshold. Municipal bond interest is the one that catches people off guard most often. Municipal bond interest is generally exempt from federal income tax, so many retirees assume it has no impact on their tax situation. But it counts toward combined income for Social Security taxation purposes, and depending on how your state treats it, it may also count toward MAGI. This can be relevant specifically for people who hold significant municipal bond positions and are surprised to find their combined income higher than expected. The broader point, the income thresholds that govern both Social Security taxation and the new senior deduction phase-out are specific numbers, and staying below them is often a matter of deliberate timing rather than luck. The strategies that help are not complicated. They're a matter of knowing the thresholds exist and planning your distributions, conversions, and realizations around them. The $6,000 senior deduction is one tool. Here are the broader strategies that work in combination with it to keep Social Security taxes as low as possible, legitimately, using the rules exactly as they were designed. Strategy 1. Roth IRA withdrawals don't count toward combined income. This is one of the most valuable retirement planning facts that most people don't internalize until they're already deep into their retirement years. Roth IRA withdrawals. Distributions from a Roth account do not count toward your combined income for the Social Security taxation formula. They don't show up in your AGI because Roth distributions are not taxable income. They are not included in the 50% of Social Security calculation. They simply don't appear in the combined income formula at all. This means that if you have both traditional IRA assets and Roth assets, and you need to pull money from your retirement accounts, pulling from the Roth instead of the traditional can help keep your combined income below the Social Security taxation thresholds. This is one of the primary reasons financial planners often recommend doing Roth conversions in the years before you begin collecting Social Security. You're converting traditional assets to Roth while your income is lower and your Social Security taxation threshold hasn't kicked in, building a pool of tax-free assets that you can draw on in retirement without affecting your Social Security tax exposure. Strategy 2. Qualified charitable distributions for IRA owners 70.5 and older. If you are 70.5 or older and own a traditional IRA, you can make what's called a qualified charitable distribution, a QCD, directly from your IRA to a qualifying charity. QCDs can satisfy some or all of your annual RMD requirement without the distribution counting as taxable income. The QCD goes directly from the IRA to the charity, bypasses your income entirely, and therefore does not add to your AGI, does not push your combined income higher, and does not reduce your senior deduction through the phase-out mechanism. For retirees who are charitably inclined and who take RMDs, QCDs can be a highly efficient strategy. You satisfy your required distribution, you make your charitable contribution, and you keep your taxable income lower than a standard distribution, followed by a separate charitable deduction would accomplish. The annual limit for QCDs is $105,000 per individual for 2026. For most retirees, their entire RMD is well within this limit, making QCDs a complete solution for managing RMD-driven income. Strategy 3. Managing capital gains realizations deliberately. Long-term capital gains are taxed at preferential rates, 0%, 15%, or 20% depending on income. But they do count toward both your AGI and your combined income formula. For retirees who are near the Social Security taxation thresholds or the senior deduction phase-out threshold, realizing capital gains can push them into a less favorable tax position in a way that spreading those realizations over 2 or more tax years would avoid. If you're thinking about selling appreciated investments, consider whether the size of the gain in any single year would push your combined income above a relevant threshold, and whether spreading the realization across 2 years would result in meaningfully better after-tax outcomes. Strategy 4. Tax loss harvesting to offset gains. In years when you do need to realize capital gains, offsetting them with tax losses elsewhere in your portfolio keeps your net recognized gain, and therefore your AGI impact, smaller. Tax loss harvesting is a well-established strategy, and it works particularly well for retirees managing combined income thresholds, because every dollar of net gain avoided is a dollar that doesn't push combined income toward or past the Social Security taxation tier thresholds. Strategy 5. Traditional IRA contributions to reduce MAGI, if eligible. If you have earned income and are still eligible to make traditional IRA contributions, those contributions reduce your MAGII, which can help preserve the full $6,000 senior deduction if your income is near the $75,000 phase-out threshold. This applies to a narrower group of people. Most retirees in the target age range have limited or no earned income, but for those still working part-time or doing freelance work, it's worth knowing. Strategy 6. Know which states have eliminated Social Security taxation. If you live in one of the 9 states that still taxes Social Security at the state level, and your income is near the threshold where state taxation kicks in, check whether your state's exemption structure creates any opportunities for timing or income management similar to the federal strategies above. Each state's rules are different, and some are more flexible than others. But being aware of the state-level picture alongside the federal picture gives you the complete map of your Social Security tax exposure.